Hey everyone, ready for another deep dive?
I'm ready.
Today we're going to be tackling the work of economist Professor Richard Werner. He has some really interesting and provocative ideas about how the financial system really works.
Yeah, he really challenges some of those basic assumptions that we all kind of take for granted.
Right. We've all heard that saying, banks lend out the money people deposit.
Yeah, that's kind of the Econ 101 explanation, right?
Sounds logical.
It makes sense on the surface.
But Werner's research suggests that that's not the whole story at all, not even close.
Yeah, it turns out that the reality is much more complicated and honestly a bit more mind-blowing.
Okay, so let's get right to it. What does Werner say is actually happening when banks make loans? Are they just shuffling money around, or is there more to it?
Well, Werner argues that banks actually create new money when they make loans. And this power to create money is what gives them a huge influence on the economy as a whole.
Hold on. Create money. That sounds almost like magic.
It does sound like magic, doesn't it? But it's not magic, it's just a process that most people don't really understand.
So how does that even work?
Well, to demonstrate it, Werner actually conducted a real-world experiment. He took out a loan from a bank.
Ah, interesting.
And he carefully tracked where that money came from.
Okay.
And what he found is that that loan wasn't simply transferred from somebody else's savings account. It was essentially created out of thin air when the bank issued the loan.
Wow. That's incredible. So banks aren't just managing existing money, they're actively shaping the amount of money in circulation.
That's exactly right. And that's why Werner's work is so important. It really challenges a lot of our basic assumptions about how the financial system works and, who holds the real power.
So today, we've got a whole stack of Werner's research. We've got articles, essays, even some interview transcripts.
Yeah.
We're going to break down his critique of conventional economics kind of step by step.
Okay, let's dive in. I'm excited to see what he has to say.
All right. He frames his argument around debunking 5 big myths that we learned in Economics 101. And the first one is all about interest rates.
Interest rates.
Yeah. So we're taught that lowering interest rates stimulates the economy, right?
Right. Makes it cheaper to borrow money, encourage businesses to invest.
And then things start to boom.
The textbook explanation?
Yeah. So does Werner agree with that?
Well, not quite. His research actually suggests something very different. He found that in many cases, periods of high economic growth were accompanied by higher interest rates.
Wait, really? Higher interest rates during high growth?
Yep, you heard that right. It kind of seems counterintuitive.
Yeah, that's totally counterintuitive to what we're usually taught.
Yeah.
So if interest rates aren't the magic lever that controls the economy, then why are central banks so focused on them?
That's the million-dollar question. Werner suggests that maybe this whole focus on interest rates is a kind of a distraction.
A distraction from what?
A way to divert our attention from the real mechanisms that actually drive economic growth.
Oh, interesting. So he thinks it's almost like a smokescreen.
Exactly. And maybe, just maybe, it allows central banks to appear to be in control while obscuring the true sources of power.
Okay. So if it's not about manipulating interest rates, what is it about? Let's move on to myth number 2. The idea that markets magically achieve this perfect balance. Economists call it equilibrium.
Yeah, I remember learning about that. Supply and demand, everything finds its perfect level.
Right. To illustrate this, imagine trying to get tickets to a sold-out concert. The sellers have all the power.
Oh, yeah. Especially these days with those dynamic pricing algorithms, it's crazy.
Totally. They've got this limited supply.
And desperate fans are willing to pay whatever it takes.
Exactly. So does Werner think that something similar is happening in the financial system?
He does, especially when it comes to the creation of new money. He says if banks are the ones creating the money supply, they essentially hold the short side of the market.
So they're like the ticket scalpers.
Kind of, yeah. It gives them this huge influence over who gets access to that newly created money.
So it's not just about some abstract economic theory. It has real-world consequences.
You got it.
It affects who gets loans, which businesses can expand, even how much things cost.
Yeah, and we're not just talking about banks lending out existing money here. We're talking about the creation of brand new money.
Okay, so let's get back to that mind-blowing concept. Banks creating money out of thin air. Time to tackle myth number 3, that banks just lend out the money we deposit.
All right. Debunking time.
I think a lot of people might be surprised to hear what Werner has to say about this one. Are you ready to have your assumptions challenged?
Oh, always. Bring it on.
All right. So is it true that banks just lend out what we deposit?
Well, as we've already touched upon, Werner says that this just isn't the case. Banks don't need to wait for someone to deposit money before they can lend it out. They create new money in the very act of making a loan.
And this isn't just some theory, right? You mentioned earlier that he did an actual experiment to prove this.
Yeah. He worked with a bank in Germany and carefully traced the origin of the funds. And it provided really clear evidence that the loan wasn't just a transfer of existing money, but actually new money created by the bank.
Wow. So what are the implications of this? What does this really mean for how we think about banks and the economy?
Well, it totally changes the script. It means that banks have far more power than we typically realize. And this power to create money has huge ripple effects throughout the whole system.
It's like there's this secret control panel behind the scenes that we didn't even know existed.
Yeah, it kind of feels like that sometimes, and a lot of people just have no idea.
So, 3 myths down. Interest rates don't control the economy the way we think. Markets don't magically find a perfect balance. And banks aren't just lending out our savings. What's myth number 4?
Myth number 4 is the idea that saving is the key to economic growth.
Okay, so think about the third world debt crisis, right?
Yeah.
Developing countries were told that they needed to save more to invest and grow. But what if that's not the whole picture? What does Werner have to say about that?
Well, he argues that developing countries, especially those with their own currencies, don't necessarily need foreign loans to invest and grow.
Okay.
He says if they can control their own credit creation, they can direct funds towards productive investments.
Interesting. And this would allow them to do that without relying on outside lenders.
Exactly. And it would help them to avoid falling into those debt traps that we've seen so often.
Makes you think about who benefits from this narrative that developing countries are always in need of external financing.
Yeah, it's definitely worth considering who's really pulling the strings there.
Okay, let's bust one more myth before we move on to Werner's solutions. Myth number 5 is the belief that deregulation always leads to economic prosperity. Is the free market always the answer?
It's a common belief, right? Let the markets do their thing and everything will sort itself out.
Yeah, but is that true?
Well, Werner might make you rethink that assumption.
Okay.
Yeah.
Let's take Germany and Japan, for example.
Yeah, those are often held up as models of economic success.
Right. But did they achieve that success purely through free market forces?
Not entirely, no. Actually, both of those countries had significant government involvement in their economic development.
Interesting. I think a lot of people would be surprised to hear that.
It challenges the conventional wisdom, for sure.
So give me an example.
Okay. Look at Japan after World War II. Their remarkable economic recovery, what's often called the Japanese economic miracle, actually happened under a system of guided capitalism.
Guided capitalism. Okay.
Yeah. They had strategic government intervention, coordination to direct investment and foster growth.
So it wasn't just the invisible hand of the free market doing its thing.
It was a combination of factors. And interestingly, Japan's economic slowdown in recent decades kind of coincided with a shift towards deregulation and a more hands-off approach to economic policy.
So maybe that invisible hand needs a little bit of guidance sometimes.
It might just need a nudge in the right direction.
It really makes you question whether this push for deregulation that we see everywhere is always the best thing, doesn't it?
It certainly opens up that conversation, and I think that's what Werner is hoping to do.
Okay, so we've debunked 5 common myths about how the financial system works. We've learned that interest rates might not be the key to growth, that markets don't magically find a perfect balance, that banks create new money when they make loans, that developing nations might not always need foreign loans to grow, and that deregulation isn't the guaranteed path to prosperity.
It's quite a lot to unpack, isn't it?
It's a lot to process. But now that we've broken down some of those myths, we're ready to dive into Werner's alternative framework for understanding and shaping the economy.
Absolutely. Let's see what he proposes instead.
And we'll start with his intriguing quantity theory of credit. That's coming up in just a bit.
All right, so we've spent some time shattering a few of those commonly held beliefs about finance.
Yeah, some big myths busted.
Now let's explore Professor Werner's alternative framework. How does finance really work? He calls it the quantity theory of credit.
Okay, the quantity theory of credit. I'm all ears, but honestly, the name sounds kind of intimidating.
I know, right?
What is it exactly? And how is it different from traditional economic theories?
Well, it's not as complicated as it sounds. The core idea is pretty simple, actually. Instead of focusing just on the price of money, interest rates, the quantity theory of credit emphasizes the quantity entity, the direction of credit.
So it's not just about how MUCH money is out there,
Right.
but also where that money is going and what it's being USD for.
Precisely. Think of it like this. Imagine you have a powerful water source. Now, a massive flood of water can be destructive, right?
Yeah, for sure.
But if you carefully channel that water, through irrigation systems, it can be used to nourish crops and sustain life.
I see where you're going with this. Credit is like the water, and the financial system is the network of channels that directs its flow.
Exactly. Werner argues that credit that's used for consumption, think like buying fancy gadgets or going on extravagant vacations, can lead to inflation. Much like too much water flooding a field can damage crops.
Right, too much of a good thing.
But when credit is directed towards productive investments, like building factories or developing new technologies, it can fuel real economic growth. Just as well-managed irrigation can lead to bountiful harvests.
Okay, I'm starting to see how this all fits together. But what about credit that's used to buy existing assets, like houses or stocks? Where does that fit into this picture?
That's a crucial question. It's one of the areas where Werner's research gets really fascinating. He found that in the UK, for example, a significant chunk of bank lending is actually going towards asset transactions.
Wait, so most of the new money being created is actually just fueling asset bubbles?
It certainly provides a different lens to look at those trends, and it also has some pretty big implications for inequality.
Yeah, because as asset prices get inflated, it's the people who already own assets that benefit the most.
Exactly. It just widens the gap between the haves and have-nots.
This is starting to feel less like an economics lecture and more like a detective story. We're uncovering these hidden mechanisms that drive wealth and power.
That's a great way to put it. Werner's work is all about shining a light on the, often opaque workings of finance, challenging those narratives that often obscure the distribution of power and its consequences.
Okay, so we've diagnosed a problem. A significant portion of credit isn't being allocated in a way that really benefits the economy or promotes a more equitable society.
Right, it's not flowing to the right places.
So what's the solution? What does Werner propose we do about this?
Well, his answer is a concept he calls credit guidance.
Credit guidance, okay.
It basically involves using policy tools to kind of nudge bank lending towards areas that would benefit society as a whole.
So instead of letting banks decide who gets loans based solely on profit, we'd have a system that encourages them to fund things like green technology, infrastructure projects, education, research and development.
Exactly. It's not about eliminating choice or micromanaging the economy. It's more about setting those parameters, creating incentives that nudge the system towards outcomes that benefit everyone, not just those at the top.
He's got a point there. It's not about taking away choices.
Right.
It's about making sure those choices are aligned with a thriving and equitable society.
Right. Think about it. Governments already use a lot of different tools to influence economic behavior, right? Taxes, subsidies, regulations, all of those things shape how businesses operate and where investment goes.
Yeah, for sure.
Credit guidance would be another tool, one that focuses on steering the flow of credit.
Okay, I'm following you so far, but this brings up a big question. Who gets to decide what's in the best interests of society? Wouldn't that give governments a lot of power?
That's a really valid concern, and it's something that Werner definitely acknowledges.
Yeah, I could see that being a slippery slope.
But he also points out that some level of guidance is already happening, just not in a transparent way. Right now, the decisions about who gets access to credit are largely made by private banks.
And those banks are driven by profit.
Exactly, their own profit motives. Credit guidance, on the other hand, would involve setting clear criteria and mechanisms for how credit is directed, ideally with public oversight to prevent corruption and abuse.
Okay, so transparency and accountability are key.
Absolutely. It's about making the process more democratic.
Has this idea of credit guidance ever been tried before? Are there real-world examples we can look to?
Definitely. Werner points to China's economic transformation.
After 1978.
Yes. China established thousands of local banks and used credit guidance policies to direct lending towards specific industries. It played a big role in their rapid development.
That's an interesting example, but I imagine some people might be a little hesitant to embrace something that looks too much like China's model.
Understandable.
There might be concerns about too much government control or stifling innovation.
Yeah, those are legitimate concerns, but the key is to find that balance, right?
Yeah.
Between guidance and market forces.
Right, so credit guidance is one potential solution, but are there others? I know Werner's a big proponent of community banks.
He is. He sees them as a really vital counterbalance to the power of those huge global financial institutions.
Those institutions have become so massive and detached from the needs of everyday people.
Absolutely. They're all about maximizing shareholder value.
Community banks, on the other hand, are smaller, locally focused, and often operate on a not-for-profit basis.
Right. It's more about supporting local businesses and families than chasing global profits.
Yeah, so it's more about building those relationships and understanding the needs of borrowers.
Exactly. Community banks have a real stake in the well-being of their communities.
It's like a more human-scale approach to banking.
It is. And yet these community banks are facing some serious challenges right now.
All kinds of challenges.
While we're seeing bank consolidation happening everywhere, smaller institutions are getting absorbed by those mega banks.
It's like those big fish are eating all the little fish.
Yeah, it's a worrying trend because as those smaller players get squeezed out, we lose diversity. We lose competition, accountability within the system.
It seems like every time I turn around, another local bank has disappeared.
I know it's happening really fast. We end up with a system that's dominated by just a handful of institutions that are driven by profit, not by the needs of their communities.
So supporting community banks seems like a no-brainer. But what about this looming threat that Werner keeps talking about, the growing power of central banks? That's where things start to feel a bit unsettling.
You're right, the push for a cashless society and the rise of central bank digital currencies, CBDCs for short, raises some pretty serious questions about control and privacy.
It's kind of unnerving to imagine a world where every single transaction is tracked and monitored by central banks. It feels like we're giving them so much power.
It's a legitimate concern, and Werner and others argue that this move towards a cashless society is part of a broader trend. Central banks consolidating their power.
So they're seeking even more control over the financial system.
Yes, and with CBDCs, they'd have access to even more data. They could track every transaction, potentially even control how we spend our money.
That's scary. It's like handing them the keys to our entire financial lives.
It's about more than just losing the convenience of cash. It's about freedom, autonomy, and the potential for abuse. What if they decided to freeze your account because they didn't like your political views?
Or restrict your spending based on your social behavior? That's getting into some really Orwellian territory.
You're telling me. It's why it's so important to be aware of these trends and to think critically about the implications. Do we really want to hand over that much power to central banks?
Okay, so we've got a lot to think about here. We've explored some serious challenges with the current financial system. We've also looked at some of Werner's proposed solutions, like credit guidance, supporting community banks. But we've also raised some red flags about these central bank digital currencies and this potential loss of financial privacy.
A lot to unpack, but where do we go from here?
It all feels a bit overwhelming. Like, what can one person really do in the face of all of these massive forces? How do we push back against a system that often seems rigged against us?
It's a big question, but I think the first step is awareness, just like we're doing now. The more people understand the system, the more likely we are to demand something better.
It's about having these conversations, right? Sharing these ideas, helping others to see those hidden mechanisms.
Exactly. And there are concrete actions we can take as well. Supporting community banks is a big one. Vote with your dollars.
Choose to support institutions that are aligned with your values.
Right. It's about being conscious consumers of financial services.
Making sure our money is supporting a system that prioritizes people over profit.
Well said. And don't underestimate the power of just talking about this stuff.
Yeah. Share what you've learned with friends, family, colleagues, anyone who will listen.
The more we raise awareness, the more we challenge those narratives, the more likely we are to see real change.
So education is key. But what about when it comes to things like proposed regulations or new technologies like those CBDCs? How can we make our voices heard?
Well, whenever these kinds of things are being debated, it's crucial to stay informed, to ask those tough questions, and to demand transparency.
Don't just accept the narratives that they're feeding us.
Exactly. Do your own research. Look for alternative perspectives. Be wary of anyone who claims to have all the answers.
No matter how expert they may seem.
Right. Look at their motives, their assumptions, their conflicts of interest.
Yeah. Become informed citizens. Don't just passively accept whatever system they decide to hand us.
Exactly. It's about reclaiming our agency. We do have the power to shape these systems.
It's about understanding that we're not just cogs in a machine. We can influence the direction of this machine, make it work for humanity, not the other way around.
Right. That brings us to another key point that Werner makes. Finance isn't just about numbers.
It's about power.
Right. Who controls those resources that shape our lives, our communities, our future?
That's a powerful realization. These financial concepts have very real-world consequences. They impact our lives, our freedoms, our sense of agency.
And the system isn't neutral. It can be used for good or bad, depending on who is wielding it.
So we have a choice to make. Do we want a system that prioritizes extraction and profits?
Or one that fosters genuine prosperity and well-being for all?
That's a choice worth fighting for.
Absolutely. This conversation has been a real eye-opener, hasn't it? Professor Werner's work really challenges us to rethink those assumptions about the financial system.
It really does. And it gives us that sense of empowerment. We're not just passive participants. We can demand change, and we can shape a better future.
It can feel daunting, but remember, even small actions can make a difference.
Yeah. Every time we support a community bank, every time we challenge a politician on their policies, every time we educate ourselves and others, we're chipping away at a system that no longer serves us.
And when people come together and demand a fairer, more sustainable system, real change becomes possible.
So to our listeners, we hope you've enjoyed this deep dive into the work of Professor Richard Werner. We hope you've come away with a renewed sense of curiosity, a healthy dose of skepticism, and a feeling of empowerment.
Keep asking questions, keep learning, keep pushing for a better financial future.
Until next time, stay curious and stay engaged. That was a lot, huh? We really went deep on Professor Werner's work, and it definitely challenges a lot of what we think we know about finance.
It does. It's a real eye-opener, and it kind of makes you wonder, where do we even go from here? The system feels so big.
Yeah, like David versus Goliath, right?
Exactly. But remember, even Goliath had a weak spot. And when it comes to systems, even massive ones, understanding their weaknesses and those pressure points, that's where we can make a difference.
So what are those pressure points? What can we actually do to make things better? It can feel kind of hopeless, like one person can't change the whole system.
I get that. But remember, even small actions can have a ripple effect. And there are definitely things we can do. Like we talked about, supporting community banks and credit unions is a huge step in the right direction, moving our money away from those mega banks that just care about profits.
Yeah, putting our money where our values are.
Exactly. And it's more than just where we bank. It's about having these conversations, sharing these ideas, helping others to understand how this system really works.
Right, like we're doing now.
Exactly. We need to demystify finance, make it accessible, encourage critical thinking.
And we need to talk to our elected officials too, right? Hold them accountable for creating a system that works for everyone, not just the wealthy and well-connected.
Absolutely. And when they propose new policies, we need to be vigilant, ask those tough questions, demand transparency.
Like with those central bank digital currencies.
Yeah, those CBDCs. We can't just blindly accept whatever system they try to hand us. We need to be informed and engaged.
So it all comes back to education and awareness. Professor Werner's work has really highlighted that the financial system isn't this neutral force. It's a powerful tool that can be used for good or bad.
And the choices we make determine which path we take.
It's kind of a stark choice, isn't it? A system that prioritizes extraction and profits above everything else.
Or one that creates genuine prosperity for all.
Yeah, it's a choice worth fighting for.
It is. It can feel daunting at times, but I think it's important to remember that we're not powerless. We each have a role to play in creating a better future.
Every time we choose a community bank over a mega bank, every time we challenge a politician, every time we learn something new about how this system works, we're chipping away at that old system and building something better.
It's those small acts of resistance multiplied by millions of people. That's how we create real change. We don't have to accept things as they are. We can demand something better.
So to our listeners, thanks for joining us on this deep dive into the sometimes confusing, sometimes scary world of finance. We hope you've learned something new and maybe even feel a little more empowered to make a difference.
Keep learning, keep asking questions, and keep pushing for a system that works for everyone.
Until next time, stay curious and stay engaged.